In this video, guys, we're going to look at the trap of trading too passively. Are you guilty of this? Hey traders and investors, a very warm welcome to you. So this is probably more geared to the active traders out there. I want to talk about this trap of trading too passively. Let me explain what I mean by that with some examples. So if you were to say, let's say you wanted to risk a maximum of $1,000 a day if you're a day trader, and you're going to take a maximum of 5 trades per day. Obviously that is $200 risk per trade. Okay, so you've got, let's put it on the board here. So you've got 200 times 5, there's your $1,000 risk. And now let's say you also say, okay, well, I'm going to trade at, if we wrap it up into a spread bet for ease for ease here, I'm going to trade $10 a point. I know it would probably be in pounds if we're spread betting, but bear with me. And I'm going to use a 20 pip stop on that. $200 is my risk per trade. I can trade 5 times a day, right? Just say that's an example. Now, if you change that and went from another extreme and kept with that $1,000 risk, which we'll keep on the board up here, let's say that's your maximum risk. Now, let's say we went to 2 trades, okay? $500 risk times 2, right? Now we can adjust our stop, or we could adjust our stop. We could say, okay, well, actually, you know what? I'm going to have a wider stop. I'm going to do $10 per point, and I'm going to do $50, 50 pips. Or I could do less than that. I could kind of do $50 times 10, whatever it may be. The point is, what I want to try to get across here is that there are multiple ways of doing stuff. And often as traders, we trade far too passively. We think that we're taking less risk by taking more shots or by having a smaller stop. We kind of think, okay, well, if I take a $10 per point and a 20 pip stop, I'm only risking $200. Maybe the case, but the reality is that's far too passive. You're probably better off increasing your position size, widening your stop a bit, but taking better trades, ultimately fewer trades. Small stops times many might equal your thousands, but if you adjust both, i.e., hey, I want a wider stop, a larger position, I still get my 1,000 risk. Very often, guys, we will think, hey, you know what, I want to reduce the risk, I want to keep my stops tight, I want to reduce the risk, I want to keep my position size small. But then at the end of the week, we look at it and we say, I've lost $2,000, or I've lost this amount of money, or I risked this amount multiplied by the trades. And you say, well, actually, if I just taken that risk capital that I was happy on losing, that $1,000, and maybe I split it into 2 and I took 2 really good high probability trades, not only would my results be better because I would have a higher probability of success, the risk reward ratio would be better, I'd be in a higher position size with those. It just works out better in the long run. So the theory is you take the better trades and you size up on those, you take more risk. You're not taking more overall risk, but rather than trading passively and splitting that up into many multiples, like, oh, $100 or $50 risk, many multiples, and then just about making some money on a few of them, or maybe probability is okay. What you do is you split it up into few multiples. Maybe going one trade, 1,000 risk is too much, but that's the one extreme to the other. Maybe, like I say, $500, 2 trades. You look for 2 good trades. You take a wider stop. You give it more chance of success. You dial up the position size on it. You make sure that you're in the right trade for a good move. That seems risky to most people. They go, oh, you know, I don't risk $500 per trade, I don't want to do it. But you're doing it effectively by trading, well, 2.5 times if you're 200, or twice or 3 times if you've got a different size position. And the risk is the same monetarily, but actually you're probably taking on more risk because you're trading these substandard setups because you don't feel as if it's too much of a problem to pull the trigger because it's only $100, $200, whatever it is. Whereas if you're trading a little bit more, you're risking 500, risking 1,000, whatever the number may be for you, you feel more inclined to make sure that trade's right. You feel more inclined to make sure you've got the right filters in place, the right trigger, the right environment, the right conditions, your mindset's right. Even though ultimately you're still risking the same amount over a longer period of time, it's going to make you more aware, more focused, and more prepared to pull the trigger. And yes, you're going to lose. Of course you're going to lose from time to time. That's the way trading works. But it's no different from losing 3 in a row of this than it is to losing $600 on one trade. And arguably you'll wait for the better trade. And you've got this diversified fallacy sometimes where, you know, let's say you're trading a basket of stocks or you're trading different currency pairs. You're like, okay, well, I'm risking 200 bucks in that, 200 bucks in that, you know, 500 in that. And you think, okay, well, actually, yeah, I've got a diversification. But ultimately, you're probably all long in the tech stocks, or you're long USD. You're short USD on one and you're long on this. And you kind of, your actual aggregate diversification isn't that much. And your risk is actually still 1,000. But in reality, maybe you're better off sticking that 1,000 on the very best play you've got. Now, the theory is, okay, but I'm diversified. If one's going to make money, it's going to be great. It's going to undo all the others. Yes, but we're traders, guys. Our job is to multiply our capital. Our capital is a tool. We're not investors here. I know some guys are watching videos. We have some videos for investors, but if we're talking about trading, which is what we're talking about here, you need to be a little bit more aggressive in the right time. So spreading risk feels like it's the right thing to do, but it doesn't, because you just make no progress. You take more risk because you've got more commissions to pay, more spread to pay, especially as a trader, all this kind of stuff. And you're never going to get the growth that you get when you wait for, maybe just pick out the big, decent trades that are ticking every single box. You trade too many times as well. We sort of alluded to this in the beginning. You're trading many multiples of times. So you're giving yourself more chance for error, giving more chance to take substandard trades. And I know from experience, guys, I've done this myself, where I've had an allocated amount of capital I'm prepared to risk in a day. I've thought that if I chop that up into multiple small pieces, that's better for me. And inevitably it's not. Chopping up into small pieces is not better, because you're trading too frequently. It's actually better to be a little bit more aggressive on the trades that really tick the boxes. So reduce the quantity of trades, increase the size. The risk is still the same, but the reward then goes up, because ultimately you're taking better trades. You start to get 3-to-1, 4-to-1. The probability of success starts to increase, rather than these kind of small little winners, a small loser, small winner, and you feel like you're just trading even and breaking even and just going nowhere because you're trading far too passively. Anyway, guys, I hope that's made some sense. Let me know your thoughts in the comment section below on that one, and also be interested to hear how you trade and whether you kind of do that and you kind of take multiple trades and believe that's a better way. I'd like to hear a counter argument for this, but I think that trading the better setups, the grade A stuff with more aggression, is a better way of trading in the long run. Take care, see you in the next one. Bye bye.